All right, let's get into it. Today, we're pulling back the curtain on a story that's hiding in plain sight. It's all about shadow money, some serious political games, and what a lot of people are starting to call the Fed's big secret for 2026.
So let's just jump right in with a wild question. What if the Fed is printing trillions of dollars and just hoping nobody notices? I mean, what if they're doing it by giving it a name that's so technical, so incredibly boring, that our eyes just glaze over? It's a huge claim for sure, so let's really unpack this theory.
You know, this whole story doesn't start with some big press conference or a flashy headline. Nope. It starts with a really quiet shift, something buried deep inside a super dry bureaucratic document that almost everyone missed back in December of 2025.
So picture this. It's December 10th, 2025. All the news, all the headlines, they're talking about this tiny expected interest rate cut. Yawn. But according to the analysis we're digging into, the real earthquake was happening totally behind the scenes. It was just quietly announced on the New York Fed's website. No big deal, right?
Okay, so what was the Fed's official line? What did they say they were doing? Let's take a look at their story. You know, the technical, nothing to see here explanation for this new, and as we'll see, very powerful program.
They gave it this name, Reserve Management Purchases, or RMP for short. And the goal? Oh, it was just to make sure the banking system had an ample level of reserves. See? It sounds like routine financial plumbing, right? Just a little technical tweak to keep the pipes from getting clogged.
So, the official playbook was this. They'd buy $40 billion a month in short-term government debt, T-bills, and they kept calling it a technical adjustment. But here's the kicker, the part you really got to pay attention to, the timeline. They said it would be elevated for a few months. I mean, talk about vague. That phrase leaves the door wide open for pretty much anything.
And this is where it gets interesting, because not everyone is buying that whole technical adjustment story, not by a long shot. In fact, more and more analysts are calling it a word game, a way to hide a much more controversial policy that they've started calling stealth QE. And this really gets to the heart of the whole counterargument. You've got guys like macro strategist Arthur Hayes who just cut right through all the fancy jargon with a super simple point. He says, whatever you call it, if the Treasury is issuing debt and the Fed is buying it, that's money printing. Plain and simple.
Okay, let's put these two things side by side. On one hand, you have quantitative easing, or QE. That's about buying long-term bonds to juice the economy. On the other, you have this new RMP, buying short-term bills to stabilize markets. QE became super politically toxic, right? While RMP just sounds like a boring technical thing. But here's what the critics are pointing to. Look at the bottom line. The actual effect? It's exactly the same. They both pump up the money supply.
And here's why that is. It's actually pretty simple. It really doesn't matter if the Fed buys a 10-year bond or a 3-month bill. The crucial part is how they pay for it. And they pay for it with brand new digital dollars, literally created out of thin air. So the end result is always the same, more money in the system. That's what economists call expanding the monetary base.
So you gotta ask, why? Why would the Fed go through all this trouble? Well, the theory goes that this decision wasn't just made in some financial bubble. No, it's deeply tied to two massive things: politics and the single biggest tech revolution happening right now, AI. I mean, think back to the early 2020s. That inflation spike was painful, and the term quantitative easing became totally radioactive. It was a political third rail. Voters hated it, politicians were terrified of it. So, according to this analysis, RMP is just a rebrand. It's a clever way to get all the good stuff from QE, the economic boost, without any of the political heat. And what this sets up is what some people are calling a perfect liquidity machine. It works like this. First, the Treasury pumps out a ton of short-term debt to fund the government. Then, step 2, the Fed steps in and buys a huge chunk of it using RMP, injecting all that new cash into the system. And then, this is the genius part, step 3, a new law called the Genius Act, apparently, forces crypto stablecoin companies to buy that exact same debt for their reserves. You see? It's a perfect, self-reinforcing loop.
So why build this incredible machine? The theory points to two really powerful motives. First motive, juice the markets with so much cash that you create this feel-good economy right before the super important 2026 midterm elections. And motive number 2, provide a fire hose of cheap money to keep the AI boom roaring ahead. Because let's be real, that industry needs an insane amount of capital for things like data centers and chips.
Okay, so this is where it gets really juicy. How does all this theory actually translate into a playbook for the markets? Let's look at the roadmap some people are forecasting for 2026.
So the forecast basically plays out in 3 acts. Act 1, the first quarter of 2026, the awakening. This is when investors start looking at the weekly data and realize, well, the Fed's balance sheet is actually growing. This is real. Then, Act 2, the second quarter, the moment of truth. The RMP program is supposed to end, which might cause a little panic. But, and this is key, the prediction is that it gets extended. And that extension is the trigger for Act 3 in the second half of the year, the explosive rally. The market finally accepts that this fire hose of cash is here to stay, and that could kick off a massive melt-up in riskier assets.
And just to give you an idea of the scale we're talking about here, I mean, just look at this number. The analysts who are all in on this stealth QE theory are throwing out some absolutely eye-popping price targets for assets like Bitcoin. Some are saying it could go as high as $200,000.
Okay, so if this is all happening, why isn't Bitcoin already at 200 grand? Well, the theory explains this with something called a cognitive lag. Basically, it's a fancy way of saying it takes time for the big money, the big institutions, to connect all the dots on a story this complex. So, the market hesitation we're seeing now, that's seen as the quiet before the storm. It's the time when the really smart money is slowly piecing the puzzle together before everyone else.
So, what this all boils down to is knowing where to look. It's about looking past the daily news chatter and the super carefully worded speeches from officials.
And here's the real split. There are 2 stories being told. Story 1 is what the public hears. The Fed chair on TV talking all tough about fighting inflation. Story 2 is what the smart money sees. They're not listening to the speeches, they're reading the Fed's weekly H4.1 report. It's probably the most boring document you'll ever see, but it has zero spin. It's just the cold, hard numbers that show you one thing. Is the Fed's balance sheet getting bigger, or is it getting smaller?
And that really brings us to the final takeaway here. Headlines and sound bites, they're temporary. They're designed for today's news cycle. But a central bank's balance sheet, that tells a much more permanent story. It's the real blueprint for where the money is actually flowing. So the question I'll leave you with is pretty simple. Which one are you going to be watching?